I want to welcome you again to our presentation concerning the mortgage rate reduction product, or the MRRP. We'll be going through a lot of information today concerning the product, and then at the end, we'll have the ability to address any questions you have via the chat function. I do want to encourage you, you can see the chat as an option on your screens. Do feel free to type any questions as we go. If it is something that we need to address at that moment, we certainly will. If I know it's something that's coming up in a few slides, I'll also make sure and notate that. Otherwise, we will have plenty of time for Q&A at the end of today's presentation. My name is Chris Endicott. I'm the MPF account manager. And again, I want to welcome you to this presentation of the mortgage rate reduction product. And we will just get going here, give you a little bit of an introduction to the product itself, talk a little bit about how it works. Really, that's one of the nice features. It doesn't really change a lot. We do want to talk about what the funding looks like. That's a piece that I think concerns a lot of people. And on the front end side of it, from the loan officer side, just being able to communicate that to your accounting department, whoever handles your demand deposit accounts here with the Federal Home Loan Bank, is important. Obviously, we want to talk about the highlights of the product. And then we're going to do a little bit of discussion on what we've learned. We've offered this product now for roughly about 4 months. It came out in February of this year, first year that we've offered this product. So we are learning as we go. And we want to be able to pass along some of what we've learned and through communications with users thus far through the product, as well as in our own interactions internally, and share that information. And then, as I mentioned, we want to finish up with a Q&A session, as well as I'll give you some next steps, depending upon your situation with the program and with this product. There could be different things that you need to do next in order to take full advantage. But with that, we'll just go ahead and get started. The mortgage rate reduction, and so that this presentation doesn't take 3 hours by me having to say mortgage rate reduction product every time, we're going to use the unfortunate acronym of MRRP to discuss it today. Not my favorite. Should have thought about that when we created the initial name, but it will speed things up a little bit as we progress through our presentation. So the subsidy product utilizes Federal Home Loan Bank grant funds, essentially. We refer to them primarily as subsidy funds, just so we don't confuse it with our turnkey products. But they are essentially grant funds, in which we will use these funds to buy down the interest rate for your borrowers and then guarantee a premium to the institution on the back end. To qualify for this, as you can see, the current rate that we're offering, and the rate we've offered since the product became available, is 5.375%. So well below the market rate currently, making it a very attractive option for homeowners. Eligible borrowers must be at 80% of the area median income, or AMI, based upon the property's location. So similar to our grant products or the turnkey products, which if you've utilized those, you're very familiar with this process. There are income guidelines and limits based on county. And so where that property is located would be the identifier for the income allowance for that particular set of borrowers. We do utilize the finance agency, or the FHFA's income limits. Those are available on the eMPF website. There is a option under resources if you've logged into the website, and geographic income information, and it will allow you to simply put in the property address, and it will identify for you that 80% of the AMI that you need to qualify for. The funds for this product are only available through the MPF traditional, and we should also put conventional products. So that is our MPF original and MPF 125 products. So those of you that utilize government or the MPF extra would not be able to sell those particular loans through this option. Those loans would work separately, would not qualify for this particular product. So how does it work? Again, as I mentioned, you primarily need to first and foremost identify the borrowers qualify based on income. Utilizing the finance agency's income limits, which had just updated in early May. So you are getting the best opportunities for your borrowers at this point. As far as we would assume, a majority of those were increases, as you might imagine, giving the borrowers the best opportunities. It must be eligible homeowner income. That is a key phrase, and we'll talk a little bit about that more here in just a minute. It does not have to be just a purchase loan. That is a key feature of this product. We are not limiting it just to purchases. We're not limiting it to first-time home buyers. This is open to any eligible borrower for any eligible product that we offer, i.e. cash out refinances along with rate term refinances. So if you have loans that you've done for borrowers that potentially could be eligible, and those have been done recently, or you could refinance those borrowers and take advantage of this particular product. From an underwriting perspective, we don't put any specific requirements on underwriting for these loans. If you currently do manually underwrite files for the MPF program, you can continue to manually underwrite the file. You simply include all the same income, appraisal, and employment documentation that you have in the past, and you simply just ensure that that income limit falls below that AMI limit we discussed. Of course, if you use automated underwriting, you can continue to do so. Using Desktop Underwriter or Loan Product Advisor, you are able to then receive your approved eligible decision, follow the conditions of that approved eligible decision. Again, if that means reduced income documentation in your file, you are able to do so. You simply do not change any of the process within the loan scenario other than verifying the income piece that we have touched on. Obviously, that is a key piece, so it will be continued to be something that we'll bring up as we go through our presentation to ensure that we get it ingrained in all of our attendees. Now, PFIs are required to document all qualifying income for all owner occupants of the property. So this is where we get into some of the gray areas and scenarios that can come up. And I'm sure when we get into our Q&A, this could be, or our chat at the end, this is exactly where it could be. We could hear some of these questions. The important thing here is all owner occupants and qualifying income. And what we mean by that is that you can't leave an eligible borrower off the loan simply to qualify for this product. So a husband and wife both working, you can't leave one of them off and they qualify knowing that that income exists. If they are both eligible for a loan, their incomes need to be included. All occupying owners on title must be borrowers on the loan and the note. This is a requirement of this product to ensure that we are documenting all of the eligible income that is available for the homeowners. The other side of this, though, is that it is not household income. So unlike our turnkey products, which if you have a grandmother that lives in the home or an 18-year-old child that lives in the home and works, that income does not need to be included if they are not a homeowner. So if they're not going to be on title, if they are not an owner of the property, it would not need to be included. The other side of that, as I said, eligible income must be included. That means if the borrower is not eligible, the income does not need to be included. If the borrower's income is not eligible, it does not need to be included. So if someone has recently changed to self-employed as a self-employed borrower, and the income does not meet the guidelines, you would not include it. Rule of thumb that I would give you is if you needed that income, could you include it? If the answer is yes, then the income needs to be included. If you needed that income and it would not be eligible and you were going to call us and hope that we would make it eligible, then it doesn't need to be included. We do include an income decision tree available on our website, and we'll give you the website address as we conclude today that can assist you with answering some of these questions. It's pretty standard, yes, no, move on to the next box, choose your own adventure type of situation, but it is available for you to hopefully answer some of these lingering questions, as well as a frequently asked questions FAQ is available through the website also. Some of the nice advantages that this product offers, as I mentioned, it doesn't really change your loan process much at all. The income piece is really the biggest hurdle, if you will, in this process. There's nothing that you put on your loan estimate. There's nowhere that you notate this. There's nothing notated on your closing disclosure. So unlike any of our grant programs where you may need to include documentation or you may need to include notations on your LEs or CDs, that's not necessary with the mortgage rate reduction product. There's no second lien filed. We're not filing any liens on this. There is no lien. This is simply a rate buy down. So everything is happening on the front end or with the closing of this transaction. Now, the standard early payoff or EPO requirements do apply. So that's the 120-day early payoff. If the loan were to liquidate prior to that 120 days, it would require you then to reimburse the program for that loan. Now, obviously, this could make some people a little apprehensive, imagining that they have to come up with the money for that buy down along with the premium piece. I certainly can understand that. I would, point out that the most likely reason that people do early payoffs is because they can get a better rate. That's going to be pretty unusual in this situation. I will tell you, if you run into this scenario as we move forward through the course of this year, do contact us. We can take a look at it and see if it's an unusual circumstance, we can work with you and attempt to accommodate that particular situation. But it should be very unlikely. We've not run into it as of yet. I don't expect that we'd run into it a great deal. And like our current products, we do allow these loans to be sold, service retained, or released. So it doesn't matter which way and you utilize the MPF program. Currently, you will continue to be able to do it that way moving forward. SRPs will simply just be based upon the SRP schedule. So if you do sell, service, release, it will simply adjust based on that. If for some reason the rate that we are offering, currently the 5.375, we're not available on the SRP schedule, meaning their rate sheet didn't go that low, just note that whatever the last SRP that they are offering at that low end, it would be what you would be paid on this particular loan. So let's talk a little bit about the funding. First and foremost, once you have access to pricing, and we'll talk about that again at the end as well if you don't already have access to the pricing, there is a special sub-product for this particular offering. You see the fixed 30-year permanent buy down product. Both the actual and actual single remittance options would be available to you. You'll note the note rate of the 5.375, and then you'll see a series of discounts listed there, all the way up to minus 4.86, et cetera, on the 60-day. What this is basically is we're identifying what the rate, or excuse me, what the price would be on this particular rate based on the market. But know that the Federal Home Loan Bank is going to be paying that 4.86 discount. And we won't be passing that along to the member with this. And then below in the red and then the festive green, you'll see the notation of this would be executed, the grid above, we will reimburse you for those, and then we will guarantee you that we'll pay you 1.5% on the back end for this loan. So it will show you the discount. And then once the loan is funded, you will then be reimbursed for that discount plus receive that 1.5% premium. You'll notice there is only one rate, so there is no ability to adjust that rate. There's no ability to move it upwards or downwards. There's no tolerance on this rate. This is the singular rate that is being offered to you. You could lock it at any variations of terms. We'll talk about that a little bit more here in a minute. But just note that right now you're guaranteed to make the 1.5% after the loan closes. Again, you lock a delivery commitment, you're guaranteed a premium of 1.5%. You would then also receive your servicing. So if you retain the servicing, just as you do now, over time, you would receive that 25 basis points annualized servicing fee. Or if you self-service released, you would receive the one-time service release premium or SRP, just as you do now. Just know that when the loan sells, that you're automatically going to receive that 1.5%. We do suggest that you lock for the 60 days, no matter what your loan scenario is. The reason obviously is it provides you the most flexibility. Your premium is going to be the 1.5% no matter what. And we're not, the cost to you isn't going to increase because you lock the longest term. The reason you lock shorter generally is to get a better price. This is the primary reason that you would do that. Well, there's no need to do that in this instance. So just to make sure that if you do run into any issues or delays or need to change a different loan in its place, that you give yourself that time frame. But we'll talk a little bit more about that 60 days here in a minute as well. It is still mandatory delivery and imperial fees do apply. But again, we have some talking points as we finalize here to discuss that a little bit more detail. So let's look at the funding. Let's go through a scenario. I just pulled one of our random loans that was delivered into the program. So if you're on the call today and you're the one who delivered this loan, congratulations. I doubt that you are, but you never know. Of the $216,000 loan, you see the rate obviously of 5.375. As I mentioned, we used the lock term price of 60 days. That created a discount of 4.3, basically 4.3%, if you will. Or if you were looking at a traditional rate sheet, you would see it as like a 95.7 on the rate sheet, meaning that you were only going to get 95% of that loan back when that loan was funded. The cost of the buy down, when you utilize that math at the 4.3 against the $216,000 loan, is the $9,307. The premium paid at the 1.5% of the 216,000 is the $3,240. The two together equate out to the $12,547.08. So again, when you're thinking about this, you're not going to really see the 9,300. You're going to see this as a combination of the 12.5 on your particular sheet. So if we look at how this looks, and this is an actual memo posting on your DDA. So if you have an accounting department, this is exactly what they will see. You will see the credits, and the credits are on the right side of this. You see the credit for the 12,547.08 and the credit for the 216. So the loan amount and the total subsidy are credited. And then you'll notice There is the interim interest, or the 30750, which is interim interest that will always be part of your loan transaction. And then the amount of the subsidy is debited. So we debit the amount of the subsidy, but we've already credited you the amount to cover that subsidy plus the premium on this loan. So it all happens at one time. It's just, we can't just, we want to credit the total loan amount, obviously, when this loan funds, so that there isn't any confusion. And, but we do also need to make sure and notate that reduction. You'll notice the coding on the right side. We identify the agent fee in this instance is the discount. So we just run it through the traditional transaction process that 4.5 or 4.7% reduction in discount equates out to that 930708 that we talked about earlier. It's then reimbursed to you through the 182 coding of MPF rate reduction subsidy. And then again, if you sell service released, you will then be credited your SRP as normal once the transaction is concluded. So let's look at a few highlights. Again, as I mentioned earlier, you don't have to be a first-time home buyer. This product is open to any eligible MPF customer, again, based on that income that we talked about already. All loan purposes, purchases, rate term refinances, cash out refinances. The rate term, obviously, we is a certain makes a lot of sense, especially if loans you've done in the last 2.5 years, right? Since we've seen the rates jump upward, you may have some individuals that you've done a loan for that would now be eligible for this product. Again, you utilize the income limits as they are today. So if they were under the 80% previously, they're certainly going to be under the 80% today. Just allowing you the ability to assist some of those borrowers in gaining some cash flow. Obviously, the cash out refinance, it might seem on the initial view of it like, why would you allow for that? But we're looking at it in the standpoint of a debt consolidation opportunity. That if you've got borrowers with a lot of credit card debt or any credit card debt relative to their income, they could have an opportunity to remove that and reduce then also that interest rate and the monthly payment that they have to make. One big feature of this, and of course, some of that's relative to where you are, but if you've got members or borrowers with family outside of our district, this is not district specific. Now, our turnkey products are. They are required to be used in Kansas, Nebraska, Colorado, or Oklahoma in our district. But this is where you are eligible to deliver MPF loans, is where you're eligible to use this product. That's, I think, something that I understand why people may have been confused by that in the past, as they are used to our turnkey programs, and this very much feels like one of those grant programs that it would follow those same restrictions, but it does not. So a nice feature there, especially if you work on any of the borders, right? If you're an Omaha institution, you've got Council Bluff. If you're a Kansas City institution, you're right on the state line. Tulsa, you're right there by Missouri and Arkansas, et cetera, et cetera. Or like I mentioned, if you've got customers who have children or relatives that live out of state but could take advantage of something like this, do make sure you take a look at it. As I mentioned, the ability to identify the income eligibility limits is very easy by simply inputting the property address into the geographic website information to very quickly identify what that income limit is for that particular property, taking a lot of that work off of your plate. As I mentioned earlier, there is no special paperwork for your borrowers to sign. There is no way your borrower really knows anything about this other than if you were to tell them. Otherwise, there is nothing that we're going to do with like normal. When the loan funds, we'll do our notification of purchase, which is a requirement under truth in lending law that we do that. But there's nothing that goes, as I mentioned, in your file. There's nothing that you have to notate on any of your disclosures to the borrower. As far as your borrower knows, you're just giving them a really good rate. Hey, you want to tell them that where it came from, that's fine, but we're not requiring that. It's not something that you need to do. It is completely up to you on how you handle that. Just note that there's not going to be anything from us. We're not going to send them, congratulations, you got one of our subsidies. That's not how this works. This is simply just something we offer to our membership in a way to hopefully facilitate and increase homeownership. We do require that delivery commitments be locked on a loan by loan basis. Okay. And really that's more for monitoring and tracking on our end. Obviously as I mentioned, this is the first year we're offering this. So we're learning as we go in some instances on what does and what doesn't work. But one way we wanted to be able to manage how quickly the money is going and who is using the money and the limits that we'll talk about here in a minute is by utilizing the loan by loan delivery commitments. We have instituted a loan volume limit per institution. And obviously we can't have somebody just go out and lock all the money at one time in a big bulk and then hopefully fund it all. We want to ensure that the money lasts as long as we can and be able to manage it effectively. And for your own benefit as well, because of the mandatory delivery concept, just locking on a loan by loan basis makes the most sense. Just quickly, there was a question on will we be able to get these slides? Absolutely. When we conclude today, we send out the slides to everybody who registered for today's presentation. There's no proprietary information in here to give you references to fall back on. Absolutely on that. Let's talk a little bit about the highlights. As I just mentioned, we have a current limit per institution of $4 million in loan volume. So that means that $216,000 loan, you'd have, just under $3.8 million remaining that you could deliver into it. We already have about 5 to 6 institutions that are capping out at that 4 million. But the good news is, as you can see here, there's still, as of to date, 49% of the money still available, roughly 4 million, a little bit over $4 million is available. Based on yesterday's activity, probably a little less than $4 million is available. But there is still plenty of funds to utilize for this product. So while, as I mentioned at the beginning, we opened this product up in February, you're not behind in this instance, in the sense that there's still plenty of opportunity to use this product. One other highlight is, just like the traditional or the your normal day-to-day, if you will, MPF program, we do not provide front-end underwriting. So we won't review your pay stubs. We won't review that information to establish if that loan is eligible. That is something that you, or through your automated underwriting or through your contract underwriting, just as you do now, would need to be able to calculate. Again, all eligible income should be included. Just as I mentioned at the beginning, the rule of thumb, if you needed that income, would you include it? You should count, then you need to include it here. If you needed that income and it could not be included, either due to borrower issues or the type of income that it is, then you would not include it. If you do have questions on what is eligible in income, you can reach out to us in Topeka. And we would encourage you. I know some people do utilize the help desk, the provider help desk, and that's great. They're a good resource as well. However, in this particular instance, because this is a Topeka specific product, this is not something offered through the system, but by us individually. They really can assist you with addressing that question from in the context that you're asking it. So I would encourage you to reach out to myself, Aaron Bramlett, I'm sure most of you are aware of, Megan Haas, are all available to assist you with attempting to answer these questions. You can email us, you can call us, and again, I'll give you that contact information as we conclude today. So again, these are some of the things that we've learned in going through this program and talking with members over the course of the last 4 months about this program. First one that is not district specific. That's one that it doesn't come up all the time, but it does come up again. And I think it's just an immediate reaction is, oh, it's just like turnkey. And so you can't do it in anywhere outside of the 4 states. That's not the case. So do feel free to take a look at any loans that you've been working with, any loans that you've done in the last 2 years, and see if there's an opportunity, regardless of where they're located, to take advantage of this product. Again, because it is not just purchase activity. It is mandatory delivery. And I've heard of every now and again, I do get a concern or a question about this. Obviously, twofold, and you can fall on both sides of this. It's like, well, most of the time loans fall out because the interest rate improves. That's not going to happen in this instance. So it does reduce the fallout percentages or likelihood, but there is still some, again, sometimes when you're dealing with, as we might assume, smaller loan sizes, borrowers that, less income, less margin for error, you could have some fallout. So I understand both sides of that. And my answer to you would be, in this particular instance and in this particular circumstance, it's really not necessary to lock that loan early. Again, as I mentioned, the primary reason that you lock a loan is to guarantee your rate and to guarantee your price. Well, we've already guaranteed both of those things, regardless of when you lock it. I can tell you that I do not at all expect this rate to go up. So you're not endangering yourself by holding off locking the loan. There has been no indication of us moving this rate upward, even as rates have gone upward since we started in February. We have not adjusted upward. If anything, we might adjust downward at some point. But again, I think that would be very unlikely at this point as well. So you can hold off locking. Again, you're guaranteed the 1.5% regardless if you did a 5-day lock or you do a 60-day lock. So now, while we talked earlier about using the 60-day locks to give yourself flexibility, that's only if you just have to lock a loan, right? Some people, I think, that's how we do it, and that's what we're going to do, and so we lock the loan. But in this particular product, it's not really necessary to do it. As I mentioned, we still have nearly 50% of the money available. It's not going to be gone in 30 days. So now we get down to 10% of the money available, something of that nature, then that tune will change. There'll be an opportunity then that it would make more sense that you do lock that loan when you're ready. We guarantee funding on any loan with a delivery commitment. Okay, so that's how so even if you lock a loan, we get down to 1-2% and you lock a loan and then we go to 0%, that's including your loan. That's in that delivery commitment. So don't be alarmed about funding it before we run out. It's really just about locking it before the funds are gone. Obviously, once the funds are gone, we won't allow any new delivery commitments to be locked. You'll notice the third bullet point, we do require transcripts for each loan. So we do request that you obtain those transcripts. We are having each of these loans quality control reviewed, specifically for the income limits, as you might imagine. If for some reason you have removed income that would show up on a tax return or a transcript, i.e. a borrower's not eligible, or as I mentioned, they were self-employed but not long enough to be eligible for that income to count according to the program guidelines, make sure that you put some notation in your file, right? If you show that their monthly income is $3,600 a month and the transcript shows their monthly income is $4,500 a month, we're going to need to know where that $900 went. And we're going to need to know why you weren't including it. Just because they're different doesn't mean you're wrong. It just means that we need to understand what adjustment that you made. And it would be better for you to tell us what you adjusted and not have us try to figure that out on our own. Because there could be very likely that the default will just be, well, it's different. We're going to go with the higher number. We don't see why they did what they did. So please just make sure if you do make any adjustments to income, just leave a note in your file, just so that if there are any questions, we know that you've taken a look at it, and we can work with that. Again, if you've sold loans into the MPREP program in the past, we want to do our best to make that loan work. We're partners in this program. You are our owners as stockholders. We don't take that lightly. And so we will do our best to try and keep every loan that is possible to be kept. We simply just need you to work with us and try to provide as much of that information as you can. But do note, yes, you will need to obtain those transcripts, not just the 4506Cs, but the actual transcripts on each of these files. So let's talk a little bit about next steps, and then we'll open it up. I know we have one question in the Q&A, and then we'll see if we have any others come after that. So what are your next steps? So there's a couple of options here depending upon where you are in the process. First and foremost, one of the nice things that's come from this product has been that we've had some institutions that have, not been as active with the program in the last year or so, come back in and utilize the program again. And that's very exciting for us. Obviously, we want as many of our members to take advantage of not just the MPF program, but especially this mortgage rate reduction product as possible. But if you need to make sure if you have an active master commitment as an institution, again, the master commitment is where you deliver the loans into the program. And if you've not delivered in a while, you may not have an active master. You can contact us. You'll see product administration, email address, our toll-free number as well. You can reach out, and we can certainly, if it is just a matter of, hey, do we have an active master? Yes, you do. We can assist you with that. You can also look it up through the EMPF website. If you go out to the MPF website, go to just any transaction option, the loan presentment, or even a delivery commitment, the first thing you're going to have to do is notate your master. And if you don't have an active one, you won't be able to do it. Next, you'll need to know, can you access the pricing? So we looked at a copy of the rate sheet earlier. As I mentioned, you have to be granted that access. It's not automatically available because we wanted to make sure that institutions understood the restrictions and the requirements of this program. Now that you've gone through this training today, we can have this substitute for our on-demand training that we've offered since February, which is available on the website, on our Topeka website, and we'll talk about that here in a minute. Again, if you can't access it, so if you were to go out to the EMPF website and access pricing and click on the 30-year fixed permanent buy down pricing, and it said you do not have access, simply email the product administration email address, or email me. And my email address will be here at the end when we look at contacts. I'm more than happy to get that set up. It takes about 24 hours for you to gain that access, but we can take care of that for you quickly. If you use a pricing engine, and what we mean by that is you use Optimal Blue, Mortec, any of the services where you have multiple investors pricing come in, and it allows you to be able to compare pricing on a loan scenario. you may need to reach out to your rep at the pricing engine and request that they add this pricing. Sometimes, maybe not to your knowledge, even if you're even the administrator for your institution on this, those systems are set up to be no automatic updates, um, meaning no new products just automatically roll in, just because there could be so many and create confusion, and you may want to not offer a product because of whatever reason there might be. So you may not be accessing this pricing yet, even if you should be able to access it. So I would encourage you to reach out to your rep, make sure that they are allowing this pricing to go through. And lastly, again, another benefit, we, at least as far as registering today, we had a couple of non-PFIs register for today's presentation. Now, in order to do this, as I mentioned, you'd have to sell these loans through the MPF product, which means you do have to be approved through the MPF program. I will tell you, when we began this process in late 2024, as far as getting things put together and creating this product, we were concerned about how quickly the money would go. And we did not want new members or non-PFIs to try to get into this product, to try to get into the program to use this product, and the funds be gone before they could use it. But that has obviously not been the case. The good thing for everyone involved is that there is ample funds available still to be utilized. So there is plenty of time, if you're not even yet a PFI, to get signed up for the program. If you are interested, please contact the MPF sales department. See the email address there, and we'll be more than happy to assist you. Again, if you don't want to do that, just feel free to reach out to me. And the default on all of this is just feel free to reach out to me. I'm more than happy to answer any questions and get you going on the next steps, regardless of where you are in the process. At this point, let me look at our questions and see what we have. So one question that we have is it asks about second liens. Let me read this question in my head. I won't read it out loud just because who needs to hear that? Very good question. I'll paraphrase the question that this product, while we do not require a second lien, the question is somebody that qualifies for this could also and very well would qualify for the HSP or the HSP product through Turnkey, which does have a retention agreement. So the question is, would that still apply? Yes. So a very good rule of thumb, we didn't really approach it in here because we're kind of running down to the end of the Turnkey or at least the HSP process. But it is a very good question to ask, that if you are utilizing this in conjunction with Turnkey or any other grant product, that you need to default to the most restrictive income and eligibility requirements. And that may unfortunately require you to go back and forth between the programs. And what I mean is that if you use HSP, home ownership set aside, then you are restricted by district, because that product is restricted by district, as well as by household income versus just borrower income or homeowner income. Likewise, if you utilize an HSP grant with the MRRP, it has to be a 30-year fixed loan. It can't be one that you would keep in your portfolio because it has to be sold to us. So you do need to be able to bounce back and forth between those particular products if you are using multiple avenues of assistance for your borrower. The question is, the next question is referencing on an expedited refi. Again, it's just you're following the program's guidelines. So if the loan qualifies for an expedited refi through the traditional MPF program, it qualifies for an expedited refinance here. And you would just adhere to any requirements for expedited refinances. I know, obviously, the advantage, as it's pointed out in the question, is that it eliminates the need for the appraisal, which obviously is a win-win, right? The whole point of this is to try to make this process more affordable for the homeowners. So if we can reduce the closing costs along with reducing the monthly output for principal and interest, it's a win-win. So definitely, if it would qualify for that expedited scenario, take full advantage of that with this program. There's no restriction on that, just simply because of the mortgage rate reduction product. Okay, those are the two questions we have right now. Again, we had the question on the slides. If you're following in the chat, Jesse has notated that the slides will be distributed and available to you. Again, let me just ask if there are any other questions. Feel free, put them into the chat / the Q&A, whichever way you wish to do it. I'm more than happy to answer those questions for you right now. If you would prefer, you can always just reach out to me afterwards. And while I'll go ahead and just put up the contact information for you. As I mentioned, I promised you contact information. My contact information, Aaron's contact information, Megan's contact information are all available to you. While the titles are different, our purpose primarily is the same, that if you call in, we'll attempt to assist you with answering your questions and get you to either the guide reference you need or relay what we've learned through previous discussions on similar questions like that. If you wish to get in, look at the decision tree, you wish to look at the FAQs or frequently asked questions on this product, if you will just go to the Topeka website, FHLBTopeka.com/MPF. Under the products, you'll see mortgage rate reduction product listed at the very bottom of the product offerings. And then it will, from there, the on-demand webinar that now you will not have to participate in to get to access pricing will be available, but as well as resources on a overall flyer of information similar to what we've covered today, as well as the decision tree and the frequently asked questions sheets are both available to you there for reference. Again, if you cannot access the pricing yet and you need access, just reach out to me. If you want to do it this week, I would reach out to me. Aaron is out of the office this week, so I can move that process forward for you to make sure you have that access to pricing as quickly as possible. Just email me and we'll take care of it for you. With that, throw out one last attempt. Is if there are any questions, please just type them into the Q&A. Okay. I will rain delay it here for a minute. Now everybody types at the same speed. But otherwise, again, if you do this, if you have questions, it's new. It's new to you. It's new to us here in Topeka. So just know that at this point, we've kind of covered a lot. There can't be too many questions we haven't got, but I've been doing this business for 20 years and I still get questions that I've never been asked before. So I will never say never. But just know you can reach out with any questions that you do have, and we will be more than happy to assist you, whether it's set up or as you move through the process. Again, we thank you very much for your time today. I show no new questions, so that no new questions, so that means that I've obviously covered everything in perfect detail. He said sarcastically. But we thank you for your time today. We thank you for the interest in this product. We hope that it will be beneficial to you and to your borrowers. And please do reach out with any questions that you do have. Thank you very much. We appreciate your time today, And I hope you have a great rest of the day and a great rest of your week. Thank you.